I'm Charlotte McLeod with investingnews.com, and here today with me is Ole Hansen, Head of Commodity Strategy at Saxo Bank. Thank you so much for being here. Great to have you.
Thank you very much for the invite, Charlotte.
Really good to be speaking with you. There's definitely a lot going on in the markets, so we've got a lot to go through. You just released your latest quarterly outlook, so I'm going to pull some topics from there. And where I thought we could start is with gold, because for our audience, it's definitely top of mind right now. So I believe you have for your top price in 2025 about 3,300 for gold, which feels pretty attainable right now. But I'm wondering if you have an idea of the timeline, how we get there. How are you seeing gold right now?
Well, I'm seeing gold as the almost as the ultimate safe haven, together with a very short end of the bond market and some currencies, especially after we had this tariff bazooka from Trump in less than just about a week ago, which then said later on was delayed by 90 days. But the damage had already been done. We've seen some significant sell-offs in the equity market. We've seen unrest in the bond market as well, with yields rising, even though on days where equity markets were falling, basically not really creating a great deal of confidence for investors for where to park their money while we go through this period of turbulence. So we've seen that also play out in the gold market. It has been an almost non-stop rally now for 2 years. So the market was long overdue a correction, but whenever we had a correction, these setbacks were relatively shallow, basically indicating there is a bit in the market every time we see a setback. So after the initial run up to a record high on the tariff announcement based on heightened recession and inflation worries, we did run into a long liquidation phase, and that basically highlights some of what happened in the market as well when we had these spikes in liquidity or in volatility. That basically means we have this dash for cash, which basically means that no investment is safe because investors need to reduce their exposure. And with gold having been a very popular investment by many, we also saw selling in gold. But the correction was only 4%, and now within a week we're almost back once again to challenging the record highs, simply because we are in a very uncertain world right now. We just have to look at the White House. We have to look at the changes that happens there on a daily basis. We have to worry about the tariffs impact on global growth. Are we seeing a recession? Is prices going to go up due to tariffs? So we're going to see inflation coming back. The geopolitical tensions, not least between the US and China, is also playing its part. Central banks buying gold in record amounts, which is likely to continue. So, and then there's the whole fiscal debt worry. So that's a long answer to a short question, but basically it's difficult not to paint a positive picture for gold for now, and that's why we have this 3,300 call. I would ideally like to see a longer period of consolidation, but it just seems like for now we're not really getting it.
I think that's a really good answer to the question and gives an idea of your thought process there. So we've got a look at where you see gold going at the high point for 2025. I wonder if we can talk a little bit more about how low gold could go, because we know it's got a positive outlook, but I also was seeing some concern among investors when we did have that pullback after the tariffs, where people worried a little bit about what was going on there. So any thoughts on how low the downside could be for gold in 2025?
Well, I'm just looking on my screen as we speak now, just to give you some exact numbers. Basically, the run up we had since December is quite an important one. But looking at the setback, the first level that you really need to keep a close eye on is 2,950. That is the highest local highs we had back in February, and it's really the level where we did find support during the latest correction. But I would say we could easily. Not easily, but we could still drop below 2,800 and still not worry too much about the correction being signaling an end to the bull run we had. So 2,950 is my big line in the sand, but 2,800 could be reached if we do run into a significant period of selling, and that selling really has to occur through a solution to some of the current issues that we are facing. Tariffs, obviously, first of all, needs to be abandoned. We need to see we need to see maybe central banks step in to support the economy further with following all the kind of near crisis atmosphere we've seen among CEOs in recent weeks, and that potentially could just create a little bit of movements back into the equity markets. But generally, it's difficult to see the risks. But you're absolutely right, Charlotte. There's nothing ever goes in a straight line, so well worth just to keep some of these levels in mind. But the first one most certainly 29.50.
Okay, I think that's really helpful as well. Let's look over to silver. So I know when you're looking at silver, you use the gold silver ratio at least somewhat to give an idea of where it's going. So if this is the outlook for gold, what do you see coming for silver in 2025?
Well, I have to start by saying, oh boy, because silver has just recently done what silver does extremely well. It's basically gold, but on steroids, meaning that when gold tends to rally, silver tends to follow, but quite often at a faster pace. But the opposite happens as well when we see a setback, and that's what we really went through. We went through quite a painful and brutal correction in the silver market in the last week or so, and basically driven by first of all that we saw correction starting in gold, but secondly the fact that silver does derive around half of its demand from industrial uses. And as the recession fears rose with tariffs going up, then we saw the industrial metal take a hit as well. And with that, there was really not much left in terms of support, at least in the short term, for silver. So we saw a massive clear out of the books of the positions held by traders around the world. Not helping that as well was the fact that in the run-up to these tariff announcements, there's been a lot of buying of silver in the New York market simply because traders in the US wanted to get silver into the US before a potential tariff was introduced. And that basically led to a massive flow of silver coming into the US market. But the tariff speech on April 2nd basically did not indicated that silver was going to be, just like gold, was going to be exempt from tariffs, and that basically took a lot of that premium out of the New York market. And then when markets started to sell off, silver basically was the floodgate opened and the floor disappeared. So we're kind of back to square one. We briefly just returned to the starting point where we were at the start of the year, and that's after we, in the meantime, had rallied by 16, 17%. Since then, we have seen the market start to recover, indicating several things. First of all, that this deleveraging has run its course, but also the fact that the industrial metals have started to recover on speculation that China will have to announce some additional stimulus measures as they are now facing this tariff war with the US. They really have to do more to incentivize domestic consumption, and that potentially could be achieved through adding more stimulus into the economy. That will help, could help some of the industrial metals, including copper, and that's feeding into silver as well. And then I think you just have to remember that silver is still 50% also an investment metal. So if gold is in demand on the safe haven, on the worries in the world, then silver will also have a supporting impact on silver. So it's trying to recover right now. That recovery process will probably be a bit slower. And as we put out in our outlook, we basically said that the silver ratio, gold silver ratio, had been struggling to every time we got up to around 92, which is a level of weakness in silver relative to gold. Silver tended, we often saw that silver started to outperform gold, with the ratio then coming back down. But with the events in the last week or so, we've seen that ratio shoot high up to 100. And as long as we have the recession fear in the market, then silver is likely to perform not as good as gold, thereby reversing a little bit of our outlook for the year. So we've had to lower our forecast for silver from above 40 to now down to the 37, 38 area, but still quite a decent increase from current levels. Also because the mining activity is a bit challenged. We're potentially seeing another year of supply deficit, which is also going to help underpin prices once we see this stabilization unfold.
So with silver, as you've been outlining, it's got its precious side and it's got its industrial side, and they're about evenly split. So do you see going forward in 2025, silver taking cues kind of equally from both of those angles?
It will most certainly, and I think over time, if we could see the industrial metals stabilize, which we haven't seen really, recently, with also a big sell-off in the copper market, then the focus in the silver market will slowly probably focus more on the investment side of things, and because also. One thing is buying gold at a record high level. Another thing is perhaps buying silver, which is still quite a bit below the record highs we saw more than a decade ago. One thing that obviously speaks a little bit against silver is the fact that central banks are buying gold, they're not buying silver. So that underlying demand that really has been a very strong force in terms of demand for gold in the last 3 years is not seen in the silver market. So it's much more dependent on individual investors, on funds looking at silver as an alternative to gold. So it may have its times, but with my forecast, I'm also looking for the ratio. I'm just looking on the screen again. The ratio is currently around 1 or 2. That over time could move back down below 90. And if that happens, then obviously we'll see silver outperform quite a bit relative to current prices and relative to where gold is.
Okay, so we'll watch that and see how that plays out. I think while we're on the note of precious metals, I wanted to mention de-dollarization, because it's one of the themes that you bring up in your report that is going to have kind of a long-term impact on commodities as a whole. So under the Trump administration, do you see that de-dollarization trend speeding up, or what are your thoughts on that?
The thought is that yes, it will. De-dollarization is basically that investors and central bank especially try to reduce their dependency on the dollar. They reduce their dependency on dollar-based assets, so U.S. government bonds. And there's several reasons for that. The most obvious is the fact that after the Russian invasion of Ukraine, the Russian central bank had its assets frozen by the West, and that really sent a shiver around among other perhaps slightly non-Westly friendly central banks, and that really triggered this massive buying spree that we've seen ever since. But I think just also just some uncertainty related to the fiscal debt situation in the U.S. We had this the famous Liz Truss moment in the UK so a while back, and where suddenly the market completely lost confidence in the bond market, and that was really, we were getting not. We're seeing the start of that early this week, not to the same extent, but there was some really strong warning signals coming through the bond market that things were not well, and I think from an investor perspective, not only central banks but others as well, you may want to reduce your exposure to the U.S. And I think then also the tariff and the trade war. The U.S. Trump's basically wants to isolate the U.S. They basically want to pull away from many global organizations. Could indicate that this U.S. exceptionalism that we have grown used to now for the past 10, 20 years, which basically means that a lot of investors have moved channeled their funds into U.S. investments, especially into the tech sector, we're seeing part of that starting to reverse, simply because U.S. is likely to go towards a period of lower growth because of the tariffs, and at the same time we're seeing stimulus and new initiatives coming into Europe, and for that matter into Asia as well. So we're seeing investors moving there. We're seeing some flows moving away from the US, and that will support this de-dollarization phase, leading to expectations or speculation right now and forecast that the dollar potentially could weaken quite a bit further in the coming months. And if it does, then obviously you do not want to be in a dollar asset. You want to be in something that benefit from a weaker dollar, and that could be gold as well.
Yeah, I was definitely going to ask you, I know it's pretty hard to talk about the tariffs right now because so much is going on and changing really from day to day and even hour to hour, but I was going to ask what you think the end game is there, and maybe, as you're saying, it is to bring the US into itself a little bit more. So for the other countries, I think we're already starting to see this, countries starting to talk about forming new alliances that don't include the US so that they can make sure that they do have secure supply lines. How do you see that playing out further among these other countries as they kind of absorb the impact of the tariffs?
Well, I can hear from your accent that I kind of guess that you are from a country north of the US. Tell me if I'm wrong. And I'm coming from Denmark, where we've had problems with Greenland. So I think the whole question that suddenly old friends are becoming foes, that is really that I think that's the main damage that potentially could come from this, and it basically also means that the tariffs are. I can understand the reason why Trump wants to break 20 years of where the U.S. economy has become more and more reliant on certain sectors where the industrial base has disappeared. But there's ways to go about it instead of being an elephant in a china shop and just basically destroying a relationship that's been built up over decades. But and that really has created, I'll say, a lot of political damage in the short to medium term, and that basically creates these, as you mentioned, maybe alliances that makes himself less dependent on the U.S. We're seeing that in Europe. We would probably have fallen asleep here, and it's probably what has happened. I think longer term is very, very good for Europe because we finally been forced to wake up and realize we have to take our own destiny in our hands, and I think that will happen in the coming years. But tariffs ultimately is a tax on the consumer. Taxes lead to higher prices, lead to the risk of high inflation, and when you have tangible assets like commodities, that will play its part in supporting commodities. So even though we've seen quite a bit of a setback in commodities, down 8% from the highs, if you look at some of the broad indices, we're still up on the year. And I think the combination of several commodities with reasonably tight supply and investors looking for tangible assets in terms to shield themselves from the threat of from rising inflation, I think will overall continue to support commodities. So from where some of these major indices are trading right now, I still see them trade higher at the end of the year.
Okay, I think that makes a lot of sense, and you got my accent exactly right. I'm speaking to you from Vancouver in Canada. So I also want to take a look at what's going on with copper. So we've been talking about these recession concerns that are really, I think, rearing their head a little bit more right now. And copper is known as this bellwether for the economy. So I'm curious about your outlook for copper and whether it does correspond to what is in store for the economy.
Copper has been, to put it mildly, crazy the last few months, simply because the market has been trying to work out what level of tariffs would eventually be applied on imports into the US. And that has led, just like we saw in silver and also to a certain extent early on in gold, but also platinum, that the futures prices in New York basically dislocated completely from the rest of the world. That has led to during a period of time led to a lot of copper being shipped to the US. We're starting to see that coming in the inventory data now. They're starting to arrive. And that has created these massive arbitrage opportunities where if you were holding copper within the US, you could basically do the arbitrage in the futures market, selling yourself short the futures and wait for the delivery and then do the exercise once again. That basically meant that at one point recently, the New York copper price was trading at a 15% premium to London, a complete dislocation, simply because the market was trying to price in the eventual level of tariffs. And again, if that tariff level ended up at 25, just like we've seen for aluminium and steel, then the discount would, or the premium would widen even further. Since then, we've seen the weakness in the market led to a lot of stop loss selling in the market, and the copper premium now is back down to around 7 or 8%, but it's still there, and we're still waiting for news on that. So that's the technical side of things. But ultimately, commodities, they depend on demand, and the demand outlook, I would say, almost no matter what's happening right now, will remain strong. The electrification of the world is ongoing. The need for copper to supply this electricity is continuing will continue to be strong. It's not only a question about the electrical vehicles; it's also data centers. It's cooling in countries with hotter climate, where the need for cooling continues to go up. So generally, the electrification will continue to play you can almost say the electrification demand in copper is the same as is supporting copper, just like central banks are supporting gold. And I think with that in mind, the downside risk in copper are relatively small. But in the short term, we really need to get some more clarification about these tariff levels, because it's just creating some extremely difficult market conditions. And what we did see was actually which I think was a good thing, because we could have seen an even further squeeze, was the fact that the market is speculating that this investigation that's currently ongoing in the U.S. will be completed sooner than normally. Would. These investigations normally can take many months. That the fact that it will complete it sooner means that this transfer of copper from the rest of the world to the US basically has stopped. And that's good, because what could have risked was that a lot of this copper basically leaving the rest of the world got stranded in the US, not coming back once these tariff walls were put up. So it has left the market less tight than we otherwise feared, and that's also why we've seen some of the setback. But generally, the outlook for supply, for mine supply in the coming years, and the outlook for demand, especially towards electrification, I think with that in mind, I'm still long-term bullish on copper. If we do get run into a period or into a recession, then obviously we have to adjust price expectations accordingly. But again, we do not expect that to last too long, and overall these general themes will eventually reassert themselves and underpin prices.
Great overview, I think, of the copper situation, and the comparison of electrification to the central banks for gold, I think, really helps me understand where to place that in terms of the copper story. So thank you for going into that. And I don't want to keep you too much longer, but I've got one more sector that I want to cover, which is oil. So I think that's also important to what's going on in energy, of course. So oil prices, they've, of course, taken a hit like many other things with this tariff news. There's also the OPEC Plus news this past week or so that is weighing on prices. So when you look out in 2025 for oil, are we looking like we're going to have another tough year? We've also got Trump and his drill baby drill. I don't know if he's still on that track.
Well, most certainly, Charlotte. Compared to the peace and calm we've seen in the market now for the past 2 years, that is most certainly done for now. And that peace and calm was really courtesy of OPEC Plus and their production cuts, because they basically, as demand was softening, they cut supply in order to maintain stable and also relatively high prices. And we all know the result of that. It invited a lot of non-OPEC producers into the fray, increasing production because of the price levels were justifying such an increase. Now that we've seen this very dramatic reversal in the past week or so, to at one point hitting a 4-year low, back to basically almost the pandemic crisis period back in 21. Where none of us want to relive that, but it just highlights that the supply demand structure has changed quite dramatically within a very short period of time. But once that happened, then obviously everyone analyzing oil markets has to come out with a revised lower their forecast. And I think probably right now we're seeing forecasts that's probably overshooting to the downside, because we are already now into with WTI trading close to we're below 60 at the time we're recording this. We're into a level where we're into the supply destruction territories from some of the high cost producers. It will not play out today or tomorrow, because a lot of these producers, they are forward hedging part of their production, so for now they can live with these lower prices. But if we stay anchored here in this low 60s, high 50s in WTI in the coming months, then eventually we will see production start to slow in the US, especially, and probably other places as well. And that will help once again balance the market, helping to offset some of the risk related to recession, but also some of the production increases that we're seeing from OPEC. Because OPEC, we have to remember that the increase that they announced, which was an acceleration from May and onwards, is basically in order to punish some of the overproducers, and we can see several things unfold in the coming months from some of these producers. Excuse me. Take Kazakhstan as an example, producing 400,000 barrels more than their quota. If they cut that down to their quota, that would basically mitigate the increase we're seeing from OPEC initially. Then we also have the sanctions against Venezuela and Iran, which is probably going to be toughened even further One thing we have noted recently is a massive buildup of military capacity in the Middle East, with a lot of assets being moved there, and there is a very firm view on Iran from the U.S. administration. So we potentially could see production slow from both Iran and Venezuela, and that would probably also help more than offset, or potentially more than offset, the increase we're seeing from some of the other OPEC producers. So all in all, I'm struggling a little bit getting too bearish on oil prices at these current levels. We got Brent down to the low 60s. We had a 65, 85 range penciled in for the year. But with the increase from OPEC, but especially with the worries about recession, that is now lowered to let's say a 60 to 80 range. But I'll be struggling to see prices collapse much further than that, simply because it will have a counterproductive impact on supply, and that will eventually help stabilize prices. So lower than what we've been used to, but not falling out a bit.
That sounds very reasonable. So thank you for covering that topic as well. I will let you go unless you had any final thoughts that you would leave investors with. Perhaps let us know where we can find you if we want to.
Absolutely. Well, I think the past couple of weeks have told us just to stay nimble. It's really difficult to make any major long-term sort of forecasts, but also just keep if you're actively trading these markets, keep your position to a level that reflects the new and higher volatility. Just like the big asset allocators, they do hedge funds. They target the volatility, and if volatility goes up, they naturally reduce the positions they hold, simply because of the bigger swings in the market. So just respect the markets, and on top of that, in terms of where you can find me, as we said at the top, I work for Saxo Bank. You can find me on Twitter at Ole_S_Hansen with an E, or you can find our output on our website, which is analysis.saxo. And obviously you can always find me on LinkedIn as well.
Okay, very good. I'll leave some links to you in the video description so people will be able to see them. And thank you so much for coming on to go over all these different markets. I really appreciate it.
No problem. My pleasure. Thank you very much.
Of course. And once again, I'm Charlotte McLeod with investnews.com, and this is Ole Hansen with Saxo Bank.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.